So it's important clearly, for us to win back the trust, we need to understand what has changed and what do the professionals in the industry need to do to adapt to that change.
Thank you, Rajiv. And I think some very, very important questions for all of us. But just stepping back a bit and looking at some of the individual experiences that we have talking to customers, and I think it's only fair that market has evolved, customers have evolved, and the expectations are also evolving. Now, there are 2 or 3 expectations that we generally find as advisors, Sumit, and I'll come to you, that really hasn't changed in some ways, right? First is the customer is looking for good absolute returns, right? Now, no matter how much our fund managers try and say relative, and if the market is down 20, and if you broke even, and we did a good job, the fact is that is still a disconnect. The second is that, like a lot of my colleagues who meet a lot of customers say, if the portfolio did well, it was because the customer was smart. If the portfolio did not do well in absolute terms, it's because I had a bad advisor. So, it is always the advisor's problem, and it should be in a sense because the customer is always right. Some very famous ad man once said that, the customer is not a fool, she is your wife. So we have to respect the fact that the customers do have expectations, which expect that, if you went back after 5 years and you showed a portfolio that had a CAGR of, let's say, 7%, when the markets really were flat, you thought you did a good job. He said, "Ye kya kar diya? 12% to mere ko, I would have made in a deposit," or something like that. How do you think as advisors, we need to gear up, maybe in our language, maybe in our expectation management, or someone said emotional quotient, etc., to manage the gap between how the industry sees performance and how the customer is still seeing performance?
Vishal, our experience at Freedom has been very, very different. Okay, so what I'll do, I'll spend a minute to explain the model because they'll articulate it better for us. So at Freedom, our focus is retail. We don't do HNI, we don't look for them. If we get it, we are lucky, we'll service them if they want. So it's not our need, it's their need to be serviced. HNI especially, that doesn't mean retail. So our definition of retail is, or mass affluent is, family income 10 lakh plus. As per our data, there are 76 lakh households in India who earn 10 lakh plus kind of an income, and they're growing at a CAGR of 14.5%. It's a huge market, untapped. Most even banks don't go to. And it's a virgin market, okay? Now in this market, it's surprising, returns don't matter. It just doesn't matter. What matters is 2 insights which we are getting. This segment of customers are saying, give me enhanced personal attention, okay? And they buy assurances. So at every point of time, when you go with any kind of a financial solution to them, first of all is how have you handled them over a period of time, depends whether they'll be open to it or not. And second, they want to be assured of the advice that it's a good quality advice. And that data for us is currently we are tracking 14,000 goals in our system. So we are a dealer group. We work with partner financial planners across the country, 250 of them as of now. So there are 14,000 goals which we are tracking, out of which 8,500 are in action. Out of those 8,500 goals, number 1 goal is education, asset allocation of 70% equity, 30% debt. And we are seeing our SIP book month on month increasing without any problem. So our experience has been very different to the so-called perception that people have any kind of a problem. And there, another insight is coming that, as we all know, saving is income minus expenses. Investment is when I save for defined goal, defined time period, defined return, and defined risk. So in our experience, Indians are very good savers. We are pathetic investors because we don't attach goals. The day you attach goals to their investment, articulation of products, giving them advice, making him stick along over a period of time is a cakewalk. So, enhance personal attention and buy assurances. These are the 2 models, and technology plays a big role in terms of doing that.
Okay. Thank you, Sumit. And Rajiv, I'll turn to you on that because insurance is, of course, as per its definition, a very long-term product, right? So when I'm signing up a policy, I'm really looking at cover for 20, 25, 30, and sometimes as long as I can get it. Now, while that's, I know the design intent, and that's what we want to do. At least some data we look at says that in the industry, persistency becomes a challenge, right? So persistency of that same policy tends to be quite low. So what do you think is really happening, which has this bit of a dichotomy where you have someone buying a very long-term product, trying to maximize protection for really the time when you really need it, much later in life maybe. But you're not willing to sort of stick on to that policy, which you should have got at a better rate because you got it younger. So how do you think we should, as an industry, deal with this?
I think, as I said at the beginning, I wish insurance was sold as protection. In the early years, the focus was more on, creating wealth. Suddenly you found from LIC to private sector, and unit-linked plans became the, foray. And a lot of distributors joined this industry new. I'm not too sure how many of them were capable of, advising, customers. So anybody with a 12th pass and, somebody would clear an IRDA exam could become an agent, resulting in people going and pushing products which had the highest commission. Now, customers didn't mind because obviously they were making money. So the 2005 or 2004 to 2008 era was one of the best, where the agent made a lot of, commission, the customers made a lot of money. And people were told that you invest money, it's a 20-year plan, but you need to just pay for 1 year. And then suddenly it became 3 years because the regulator said that you need to pay minimum for 3 years before you, can surrender a contract. And then the regulator said 3 years is also not adequate, so we make it 5 years. So 20-year plans and 25-year plans were on paper. While the design, as you rightly said, was the intent was clearly to give a long-term, product. And the nature of unit-linked plans worldwide obviously is to stay long, if you want to really make money. But the product was pushed as double your money in 1 year or double your money in 3 years. And a lot of agents came into this industry with a short-term, objective, pushed these products aggressively, sold 20-year plans as 1 year plan and 3 year plans, and that impacted persistency to a large extent. Now, what the industry has done, obviously I can restrict myself to SBI Life, is we witnessed this way back in 2006, 2007, that this was the scenario where while we were doing very well on new business front, on the persistency front, we were one of the worst. Not even among the top in the industry. So there, I think we put in, steps in place where we said that substantial commission, which we pay to the agent in the first year, when I say substantial, about 1/4 or, a little more than that, would be paid to the agent provided we get, the second and third year, renewal premium. We linked a lot of incentives, subject to minimum persistency level. So if he was due for a lot of incentives, we would pay some incentives in the beginning. And majority of the incentives would get paid in the second and third year, for the person. And for the employees of SBI Life who deal with agents, all their promotions and, the schemes were all clearly linked to persistency. And trust me, I think SBI Life, if you look at the last 3 years particularly, has perhaps been the only company which is growing on renewal premium. Most others probably face this issue of renewal premium coming down, and we today perhaps proud ourselves being one of the top 3 in renewal persistency, in terms of ensuring persistency becomes a big role. And going forward, we have taken steps ahead in terms of measuring persistency for 66th month and 48th month, because we believe that unless we start looking at long-term persistency, today we were only looking at second and third year. Now, most of our plans are now looking at more long-term, and we believe that this is one area where we will focus very hard and we will treat low persistency as, poor performance, irrespective of what new business an agent or an employee gets in the system.
Thank you, Rajiv. And I think very interesting to note that, compensation and how the agent or how the advisor gets paid can be a big driver in sort of changing behavior and therefore leading out to a good result. And I think obviously there have been many regulatory changes or guidance in that direction across product design, across types of products, right? Whether insurance or funds, etc. But coming to Siddharth, I think one of the things that in the equity market that we generally see is that a bit of a dichotomy. We are trying to sell a product which supposedly is a long-term product that you hold for long-term, knowing that short-term there will be volatility, etc. But over the long term, it gives you better returns. But whether it's the broker or the advisor is basically getting an amount lump sum upfront.